Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, July 7th, just before 6 p.m. Eastern Time, coming to you from stormy St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at next week, and check out the updated world famous 21 over 21 leaders list. The theme for the Big Show usually is a summary for the week, and this week it's called Rates Break Out While Stocks Pull Back. Definitely more complications added to what's going on with the market. We'll sum it all up for you by the end of this video. So let's check, first of all, the trend gauge over here. Market leaders still bullish. Only one taken off from last week, and that was discretionary, and I'll explain that when we get to that part of the show. Short-term 21-day moving average. Yesterday we had, excuse me, the Dow and small caps below the 21. Small caps recaptured it. Decent breadth today because small caps and mid caps outperformed. Really, the laggards today were what has been leading, that being the big seven NASDAQ stocks. So still showing uptrend for there. Dow 2 closes below is the only weakness there, but the Dow has been weak for a while. Medium term, 50-day moving average, all five indexes above their 50-day moving average. We continue, it's been weeks now, to have the stop sign out there with the NASDAQ 100. It has pulled back, but is still 6% extended above the 50-day moving average. That's right on the outskirts of the caution level. We pulled back from 11.6%. That was the recent high, and we'll take a look at that when we get to the charts. Long-term, all five indexes above their 200-day moving average. So what happened today? Well, yesterday was a weekday because ADP came out with a jobs report that just blew away estimates that indicated that the employment picture was much stronger than was expected. Uh, the ADP survey often disagrees with the government survey. The government survey came out this morning, and the number of jobs added was actually below expectations. So immediately you say, well, ADP was wrong, we're going to rally. But if you dig into it a little deeper, average hourly earnings increased, and that's inflationary, and that's not something that the market wanted to see. So the knee-jerk reaction off of NFP was higher, and then we started selling off. By the time we opened, we were down about 0.25% on the S&P, a little bit stronger, down 0.1% on the NASDAQ, and slightly positive on small caps. We went sideways for a little while, and then a very strong rally. We were up till the early afternoon, up about 0.7% on the S&P 500, and really everything was looking great right out of the box. Even though the indexes were lagging, there was money flowing into leading stocks. They far outperformed what the indexes were doing. Then the indexes played catch up. But then around 1 o'clock this afternoon, we just started leaking lower, and it accelerated into the close. Uh, Rates ended up higher for the day. Uh, and obviously that's higher for longer is what the market is looking at right now because of the strong economic data that's been coming out, and it doesn't like it. We had a breakout this week on the 10-year, the 30-year, the 5-year, the 2-year. You see where I'm getting at here? Higher rates are not good for business. The Fed doesn't want. They're trying to keep a cap on them because of how strong their recent uh, increases have been over the past year, just trying to tamp down all the money that was flooded into the economy after COVID. But and inflation has come down quite a bit. But I mean, when our average hourly earnings are still 4.5% over the last year, you're not going to get to a 2% inflation rate. So the market showing a lot of indecision, rallying both ways, up, down, strong trends. Uh, it's hard to trust anything this week, but the bottom line for the week really was that stocks took a break while rates broke out, and we'll see how next week handles it. So here are the numbers on the day. RG8, this is our 8 growth ETF composite. Strong day today, up 0.6%. As I said, leaders had a great day, even outperforming the indexes. A couple of them stumbled. It's never a perfect picture in any case for any market, but um, for the most part, okay. S&P 500 closed basically about where it opened, but made a big round trip of about 0.8%. In actually, let's see, the range was, yeah, right about 1%. So 0.8% or so round trip, down third of a percent on the day. Same thing with NASDAQ 100. Dow Jones Industrial Average down, the weakest of the index is down 0.55%. Mid cap strong, up 0.9. Russell even stronger, up 1.2. Global 60/40 up 0.10%. Basically, uh, outside developed stocks had a really strong day, and then the big caps dragged it down, and bonds, the broad bond index, slightly lower. GROTECTION on the day, up over 1.2% at one point. That strong fade brought us all the way back to slightly negative by the end of the day. We'll hit the tail of the tape and the 21 over 21 list. Lots to get into, lots of cross currents, lots of indecision in the market this week. But really, if you are summing the market up, well, let me bring in weekly charts here. I like to do this on a Friday so you can see what the actual performance was for the week, as well as what we did uh, for today, and showing the daily chart. So in the upper right hand corner, I'll overlap these and you'll be able to see what happened for the week, where we closed for the week and what we did for the day. But if you bottom line it, we got up on the S&P 500 on 615, 616. This was basically consider this the left side of the current base that we're building. I'm going to kind of draw it here. And then we tried to break out above that late last week. It did see some strength, but really what we're looking at is, and you can see it over here on the weekly chart too, it shows up as a 4-week base on the S&P 500 on a weekly chart, about a 3-week base. You don't count the days. You start from the top, even though we did try to break out here, but I'm just going to call this a big base that we're forming. We had a harsh sell-off after getting too extended. If you can remember, we were on 615 at the top there, the closing top. We were this is the S&P 500. We got 6%. That's on the outskirts of the high side before we bring the red flag out for the S&P. We went a little bit higher and then pulled back the next day and had a pretty harsh week and a half pullback. Held the 21 EMA, had a bounce. So this inflection point is the low from 624, actually 626. That's a Monday, is the bottom of that base. We had the big gap up last week on tame inflation data. We held that on Monday. Tuesday was the holiday. We held it on Wednesday. Thursday was the surprise NFP report, or the surprise ADP report. Today was the NFP report, and you can see the big range and the negative reversal with the close at the low, unable to hold the ADMA on the S&P 500. Let's go to the NASDAQ 100. We know how crazy extended this got on 615, 11.6%, a little bit more than that, but down to 10.6% on the close by 616. If I draw this again, we didn't exceed that high on the NASDAQ 100, and that's one of the uh, things that I've been pointing out is this relative strength line on the NASDAQ is slowly making higher or lower highs, and we want that, even though price is attempting at higher highs and didn't quite get there. We want to see this come down. Markets can't go up in a straight line forever. You can see if you look at the weekly chart here, Again, a 4-week base is what we got going on after that breakout. And there's nothing wrong with that. Now, on the downside, we've got interest rates breaking out, and we're heading into the seasonally weak part of the year. The Nasdaq 100 normally tops mid-July. July is normally a pretty decent month for the S&P 500, but weaker toward the latter half of July. And then August and September are not good for the market on a seasonality basis. I'm going with data from the Trader's Almanac, but to sum up where we are, we're in a 3 to 4 week base, depending if you're looking at the daily or the weekly. And the market's resting here. There's a lot of chopping around, and factor in the rates breakout, and we'll get to that in a second. That adds another uh, headwind to the market. So let's go from the NASDAQ 100 to the Dow. Again, you can see really the 3 to 4 week base from not didn't have the clean breakout that we had on the tech heavier indexes, but relative strength continues to lag big time on the Dow Jones Industrial Average. But again, about a 3 or 4 week base here, depending on if you're looking at the daily or the weekly. Mid caps did make a higher high. So technically, they did break out of this cup and handle and are now pulling back into the handle. We bounced at the 21, which is really what we wanted to see. And then a mid-range close today back above the 80 MA. Note the relative strength on mid caps over the last 3 weeks. Relative strength line is pretty much close to the high, even though price isn't quite at the high. Let's close it with small caps now. We had the ugly day in small caps yesterday, closed off below that 180 level. Really strong support back above the 21-day today. And again, you can see really it's looking like a 5 week base for the small caps here, and a 4 to 5 week base, which is corresponds with being the handle in this big cup and handle. So we're chopping around, going sideways in this range between 180 and 189.24, excuse me, on small caps. Let's flip to the dollar. Dollar had an ugly day. Uh, Interest rates higher, but dollar lower. You can see the big move down 0.84%. It's still trading in a range for like about 8 weeks now. Uh, and with the dollar down, you would expect strength in precious metals. And we did get that today. We'll start off with SLV up 1.68%. So holding the 200-day moving average, can't get above the 21-day moving average. That 20-day moving average has been a thorn in the side of precious metals. So we didn't make a new low, undercut 1 day below the 200, closed basically just below the 200. A break below the declining 21-day moving average would be a change in character for gold stocks and also for gold GLD. You can see the inability to get there. Much better relative strength on gold relative to the gold stocks, nowhere near the 200-day moving average. Let's flip to the VIX, which had a big panic move up yesterday through the 50-day moving average, closed below it by the end of the day. 50-day moving average was the high for the day, and now we're stuck between the uptrending 21 and the downtrending 50-day moving average. So this will be very easy or very interesting to watch next week. You know, this 15 level had been the top of the range for about 4 weeks while we base. But now we're above the 21. That's a slight change in character on the VIX, and that corresponds with the overall weakness that we saw in stocks this week. Today, RSP, the equal weighted indexes outperformed. You can see RSP positive here by 0.25% since we were dragged down by the big cap stocks QQEW, the equal weight NASDAQ, just flat as opposed to being down 0.33% on the cap weighted. Let's flip to bonds now. The broad bond index BND down slightly on the day. You can see it gapped higher and then faded. A new weekly closing low. Terrible week, frankly. 1.64% down for bonds. So you're going to see on the weekly chart how much we were substantially up for the week on the 10-year and the 30-year. I'm going to show the 5-year also. Let's flip to TLT. This is the 30-year bond, lower closing low, down 3.75% on the week. So basically failed breakout above these declining moving averages and then a really bad week. So let's take a look at the 30-year yield now, 0TYX. Remember this abandoned baby right here? Well, we rejoined it after false breakout, false breakdown. We're back to the other end of the spectrum now. So we want to see if this 4% level holds. This is a new high going all the way back to November. So 8-month highs on interest rates is not good for businesses in any way, shape, or form. TYX, TNX is the 10-year breakout also. Here's the abandoned baby, then a false breakdown. Rates all over the place this year, along with stocks that generally have been higher, but we had a tough February and early March also. Same thing, 8-month highs on the TNX, 5-year FVX, 8-month highs there also breaking above where we were in early March, and up 5% for the 5-year. I didn't highlight the weekly. Up 4.6% on the 30-year, the 10-year up 6%. So this is not good for stocks. We first brought it to your attention Wednesday or actually Thursday when we had that breakout above on the ADP report, and not so well received was by the end of the day was the NFP, non-farm payroll government report. So that's all the inner asset correlation. Nope, it's not all of it. There's one more. Bitcoin fading on the week, down 4.7% for the week, but this is just putting in a pretty decent looking handle here after this huge week up 3 weeks ago. You can see the handle being formed, like 3 weeks, just 1 week shorter than what we're showing on the indexes, but trying to work off that big move up 3 weeks ago. So that's all the inter-asset correlation we look at. Let's get to the tail of the tape here. You can pause this. We're neutral on the stochastics on the RG8 and the indexes. NASI RSI has rolled over. Dollar neutral, still in a range. TNX, TYX, breakout to 8-month highs. That's highlighted in red because guess what? It's not good. Also want to point out, I didn't touch on this yesterday, but bulls are at a yearly high on the AAII survey, up 5 points from last week to 46, down 2 on neutral, down 3 on bears. There's the NFP report, below expectations on the numbers, but average hourly earnings above expectations, and that's a negative. I've got this highlighted in yellow. Really, the bottom line for the week is that we're in a 3-week base on the S&P and the NASDAQ 100. Throw in the other indexes too to a varying degree. The day count, third day down, 24-day rally though. First day below the ADMA. Yesterday was basically closing right on it, and 29 days above the 21-day moving average. This is more. This is stretched by historical counts of how long we trend above the 21 on the S&P 500, and the fact that that combined with the fact that the NASDAQ 100 is 6% extended from the 50-day is still certainly a cause for concern. Imagine next week if we pull back 6%, it would feel like Armageddon based on what we've been dealing with in the big cap indexes this year. So we're on guard. That's the market will take us out of our positions. It took us out of one today. We got shaken out a little bit yesterday, and we'll talk about the changes that we made to the portfolio here in a moment. Negative reversal took us back below the support resistance levels. That's not a positive either, although it's just a point below on the S&P and just a quarter below on the NASDAQ 100. Again, I really didn't like this acceleration down to close near the low of the day, but if you step back, we're just in a 3-week base. Is that base are we gonna break out eventually? We will, one way or the other. I've listed all the things that we have going in our face, including seasonality and the rates. And we'll see. The market deals a couple cards every day, and our job is to interpret them, avoid big losses, and participate in uptrends. And that's what our rules have us doing. Strong on the day. Regional banks, big banks too. Oils, exceptionally strong oils. And I'm going to note this when we get to the 21 over 21. Possible changing character here. Pick, which is base metals, gold and silver stocks. Block. This is the stocks that are associated with Bitcoin and or blockchain, like Riot, Mara, MSTR. They had decent days today. Jets continues to be strong. Cruise lines continue to be strong. People spending money on experiences continues to be strong. On the downside, bond prices, the dollar, and defensive indexes were the laggard today, not growth. XLP, UVRE, that's staples, utilities, healthcare, and real estate. So as far as the portfolio goes, the strength this morning, we closed our SQQQ hedge, and that looked like a great move up until around 1 o'clock Eastern time today. Also, in the meantime, DT uh, broke out. We added to that. That reversed by the end of the day. We also bought NAIL as ITB, undercut and reclaimed the 21-day moving average, buying it on weakness. Nice stop below the lows of this week. And then by the end of the day, the market took us out of MDB. So let's take a look at these stocks, these tickers very quickly. We'll start with ITB. You can see sitting here, we undercut, closed right on the 21. We were showing strength all day today for the week, 4.10% pullback, normal considering the move up that we had before this reversal. Maybe talking about this a lot since we just added it to our charts permanently now. This orange line here, which is the 21-day exponential moving average of the relative strength line. We were above it, but closed back below it by the end of the day with the negative reversal. But this is a low risk entry. This was the ideal entry. I said to the guys, if you ever see a setup like this, where the stochastic, the moving averages all come together with volume on 6-2 and I don't buy it, you need to hit me over the head with something. I also had another chance to buy it the next day and didn't do it, and on the 6th and didn't do it. We look at things a lot and we make decisions, and sometimes we do it and sometimes we do it and regret it, and sometimes we don't do it and regret it. This was a error of omission very clearly, as this was a very nice multi-week run up in the building stocks. First pullback to the 21 since then. Very often the first 21 pullback holds after the uptrend, but with interest rates rising, I wouldn't be surprised if this fails. So that's ITB. We bought NAIL off of this, but we're using the ITB chart to make the decisions. You never make your chart decisions off of a derivative. You always do it off of the underlying. So that's ITB. What else did I say? We got rid of the Qs. DT, very nice breakout early, big volume, had everything we were looking for. Look at this move up, look at the volume, and then it reversed ugly by the end of the day. That's not a candle you want to end the week with. Did hold the 21, but this break above 52 was a major disappointment today. And then there's MDB, which now is looking like a false breakout above the 400 level from last week. Held on Monday, 3 down days, although it closed at the top of the range, sold off hard into the close today, was really weak all day on no news. It's really, if just in a 6-week consolidation, you can see here on the weekly chart, down 5.4% on the week. But with weakness coming into the market, both of our buys on this were underwater by like 3 and 4%, 2% buys on each. Didn't get to our maximum loss, but we sold them out with the weak close and the weakness today. And not taking, if it was going to be a true leader like NVIDIA and Tesla are, it would have continued this breakout higher. It didn't. So as for now, it's not. You saw the relative strength line roll over. It's right on with the 21-day exponential moving average of the RS line. So we stopped out of MDB by the end of the day. So bottom line on the changes to the index, upped our volatility adjusted beta from 1.95 to 2.17. Bottom line for the day, weak open on NFP data, strong rally, ugly reversal, close at the lows. And then for the week, we're in a 3-week base on the indexes, but interest rates breaking out to an 8-month high. Those are the three highlights for the week, and we'll see what next week brings to us. And now we will get to the 21 over 21 updated list. Let's sort. We always want to sort this inverse to show the newest stocks being added. So the only thing actually that got taken off of here, SOX. I kicked SOX out. Let's take a look at that chart first. Could have kept it on there. Down 2.5% for the week. We still own NVIDIA. We were in SOXL, the negative reversal, and then or the gap down yesterday and the negative reversal today. Relative strength not confirming the new highs on the index below the 21E on the RS line, kicked it out. And the stock that we added, I have Schlumberger here. I basically could flip a coin. Schlumberger, this is exceptional strength in a big cap stock. 141% above average volume, up 8.61%. Its cousin stock in the oil services group is Halliburton, also a breakout above average volume. But really, the leading stock is TDW, oil and gas field services. Broke out before this did. Beautiful flat base here. 2-day pullback right to the ADMA, and then up on bigger volume today. In fact, I'm going to go with this over Schlumberger because this is showing real leadership where Schlumberger is still down in its base. But the bottom line is, although XLE on the week was down 0.5% on the week, it had a good close for the week. Let's then go to XOP. This is the Explorers. XLE is basically Chevron and Exxon. A good close on the week, just barely down for the Explorers. But OIH, and I'm reaching out to a couple of people I know that are very knowledgeable in the oil sector. This big day up on OIH. Normally, oil and oil services stocks only do well if there's going to be a bunch of capital expenditures by the companies that produce, refine, transport the oil. So I don't really know what this means. I'll probably know more about it what does it mean when services run before the other uh, subgroups within the oil sector. We'll chew it over the weekend and see what we get from there. But TDW, Tidewater, definitely a leader in oil services, high PE, but look at the growth on this. And we put another oil stock in a couple of weeks ago, and you'll see that chart in a minute. So TDW added, the SOX taken out. Let me delete that. So these are leftovers from last week. Generac was extended. Look at the volume on this. Broke out from this cup base. I said it needed a handle. We got a handle. A little bit more volume than we wanted with the handle, but it broke or it bounced right at the 21 EMA. But the ADMA has rolled over. I've got an alert set. If this gets back above the ADMA, I would consider buying it. SMCI, great week, up 4.3%, closing near the highs of the range. Weatherford, this is the other oil stock, also broke out. Here's the cup and handle, wasn't quite ready yet. Below the 50-day moving average, showed relative strength last week and this week. Bounced off the 21 yesterday. Volume came in today, 46% up 5.7% on the day, and clearing all of this resistance around 67 with authority. We've got a resistance up around this 70 level from over here in the beginning of the year, but that's where it is right now. So 2 oil stocks in the 21 over 21 for the first time in a long time. Dave & Buster's continues to show some good action. It's a little choppy, but a pretty good day. Didn't even touch the 21 this week. Mongo, We already discussed this, stopping out of this. It's still above the 21, but I didn't care for the pause, and we were underwater by the end of the week on both buys. Caterpillar strength today in this handle in the industrials. Industrials, the fourth strongest of the spider sectors. This also looks good. Unity Software bounced off the 21 EMA. Uh, Lighter volume. You can see the big volume on the move up where it was being accumulated, lower volume on the sell-offs. Palo Alto, maybe time for a break on this after just a beautiful run, multi-week run up along the ADMA. This is model book stuff here when you can get a 20+% run without even breaking the ADMA. That's a license to print money. You never know it's coming until it's here, but it was very clearly a leader with this reaction on its earnings report. And I didn't buy it because I'm an idiot. That's the only explanation I have. Chat, this is basing relative weakness, however, over the last 3 weeks needs to hold the 28 level because the top stocks in this are the AI FANG type big names, and they just maybe due for a rest. I pointed out the relative weakness in QQQ. It's subtle, but it's there, and they're extended, so they need a break. And if they break, chat's going to break too. Toll Brothers, home builder, bounced off the 21. Tesla uh, held the gains from the gap up after they reported their deliveries on Monday, up 4.8% on the week. Looks great to me. Live Nation just continues to chug its way higher, not on heavy volume, but it's under accumulation, very clearly riding the ADMA higher. This is one where we didn't really get an opportune volume event or price event to make us add to it. So we just have the original 2% of our pilot buy. Dynatrace, disappointment with the negative reversal. We already discussed this. ELF, perfect pullback to 100 3 weeks ago. Again, didn't buy it. Pulling back again. What'll happen is I'll end up buying this, and that'll be the top. I'm quite sure of it. Celsius flagging. Food and beverage stocks have been weak. We're mildly concerned about that. This is the leader in them, but it better hold yesterday's low and the 21. Uber holding the 21 just barely. Multiple regulatory overhangs with this. Maybe just time. It did hit pivot plus 20%. May just be time for it to rest and go sideways. Intuitive Surgical continues to hold the 21. DraftKings, big day today. No volume, though. I certainly would have preferred to see some volume with this big move. This stock drives me nuts with its moves up and then harsh pullbacks. And I gave no consideration to buying this when I saw it moving today. Race, 2.5-year wait for a Ferrari. Relative strength, weak for a while, reclaimed its strength last week. Nice digestion week for it. And finally, the king of the market right now, NVIDIA, up 0.5% for the week, just going sideways after pulling back to the 21, regaining the 8. NVIDIA, after its monster earnings report back on 525, has continued to show strength, and sell-offs are bought. And that's the bottom line for that. And that is going to wrap the 21 over 21 and the video for the week ending Friday, July 7th. Remember, it's not how much you make in the market, it's how much of that you can keep. Feel free to reach out to me or my partner, Dan or Don, at revereasset.com. Our phone's 855-REAL-WEALTH. That's 855-732-5932. And thanks for joining us. We appreciate. We broke 1,000 subscribers to YouTube. Please tell your friends and family about this. Hit the subscribe button. Hit like. It helps with the algos for getting our videos recognized. We're trying to spread the word that you don't have to be a patsy to the decisions of what the market does. You can be active with sound rules, avoid harsh drawdowns like we did last year, and participate in uptrends like we're doing this year. So that's it for the week ending Friday, July 7th. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening and have a great weekend.